In the previous episode, I delved into the Chinese government's reasoning behind pushing up the A-shares market. The takeaway was this. The main goal of the Chinese Communist Party in lifting the A-shares is to allow state-owned enterprises to raise cheap funds through the stock market, which in turn boosts fourth quarter GDP. This move is aimed at reducing the financial strain on local governments, and in the future, local fiscal strategies may shift from relying on land sales to depending on additional stock market offerings. In this episode, I want to discuss the core issue behind the stock market, reviving China's economy. With the stock market on the rise, does this signal hope for economic recovery? Hi, welcome to Dig Into China. I'm Dong Sheng. Our generation has gone through the 4 trillion yuan economic rescue in 2008, the stock market crash in 2015, and the housing price surge to clear inventory. Each time, the Chinese government managed to successfully stabilize the market. But what sets the current situation apart from 2008 and 2015? Most importantly, what does it mean for Xi Jinping? To truly understand his approach to managing China's economy, we first need to understand the dictator's mindset. Lately, there's been growing momentum among domestic economists for stronger fiscal measures, with some even advocating for a 10 trillion yuan stimulus. But is 10 trillion sufficient at this time? Let's take a look by comparing the market interventions of 2008, 2015, and this year. Let's begin by comparing the market rescue environments of 2008, 2015, and today. In 2008, the US financial crisis had a direct impact on China, leading to a sharp decline in overseas demand and a drop in exports. The economic structure back then was quite different from now. China wasn't yet the infrastructure giant it is today. At that time, import-export trade made up a large share of GDP, accounting for 60%. As a result, when external demand collapsed, China quickly faced a wave of factory closures and soaring unemployment. At that time, Premier Wen Jiabao introduced a substantial 4 trillion yuan stimulus plan. Many young people and even the international community might not be aware of how this plan came to be. In reality, Wen Jiabao had several options to consider. The first proposal was the Harmonious World Plan, which essentially aimed to replicate the US Marshall Plan after World War II. With external demand dwindling, the idea was for China to develop its own external market. This concept was later appropriated by Xi Jinping and evolved into what we now know as the Belt and Road Initiative. The goal was to support a number of underdeveloped countries in Asia, Africa, and Latin America, encouraging them to purchase Chinese goods. So why didn't Wen Jiabao go with this plan? He felt that many of the Asian, African, and Latin American countries were too unstable and unlikely to be helped effectively. At that time, China was still following Jiang Zemin's low-key, profit-oriented approach. One was wary of this risk. If China supported these countries and they ended up defaulting on their debts, would China really want to build a fleet of aircraft carriers to demand a repayment? Ultimately, he decided the business risks were too great and chose not to pursue it. Now let's examine why Xi Jinping later decided to revive the plan that Wen Jiabao had discarded. His main reason was that he felt confident in his ability to handle debt collection, and his goals had shifted. While Wen Jiabao aimed to expand exports, Xi was focused on economic colonization and establishing control over ports and docks in these countries. Wen Jiabao also had a second option, to raise people's income and shift China's economy from relying on external demand to focusing on domestic consumption. But why was this proposal ultimately rejected? It was because the interests of entrenched beneficiaries couldn't be challenged. If you redistribute more benefits to residents, whose income would take a hit? Would it be the government or the privileged red capitalist entrepreneurs? In the end, to avoid offending anyone, he had no choice but to pass on that option. Wen Jiabao also had a third option, industrial upgrading. However, the major issue with this approach was that it would not benefit him personally. Pursuing industrial upgrading would require the government to endure economic downturns and high unemployment, all while facing immense pressure to allocate limited resources to this effort. Moreover, if the upgrade succeeded, the benefits would likely be enjoyed by the next administration, leaving Wen with little to gain. He might even face criticism from the public for the difficulties people experienced during his time in office. As a result, he ultimately chose to eliminate this option as well. With all these viable options off the table, the only remaining solution for economic recovery was to pour money into investments. This is how the 4 trillion yuan stimulus plan of 2008 came about. If we examine where the funds were allocated, they primarily went into real estate and infrastructure, emphasizing investment as the key drive for economic growth, essentially using cash to boost the GDP. Since 2008, China has predominantly relied on investment to fuel economic growth. If we consider the 2008 stimulus, which involved injecting 4 trillion yuan as a way to boost the GDP through cash, then Li Keqiang's 2015 strategy focused on raising prices of housing to reduce inventory and reignite the real estate market. What was the broader context for the 2015 stimulus? While many might remember the stock market crash, that was just a trigger. The underlying issue was that starting in 2012, China entered a prolonged period of deflation, with the producer price index declining for 54 consecutive months. The deflation in the Chinese economy at that time stemmed largely from the significant side effects of Wen Jiabao's 4 trillion yuan stimulus in 2008. The government's indiscriminate investment aimed at boosting GDP resulted in 2 major issues: overcapacity and the runaway government debt. This was the economic situation Li Keqiang encountered when he became premier in 2012. As a result, he had to clean up the mess left by Wen Jiabao. Li called for structural adjustments regulating the real estate sector and the large infrastructure projects, while also tackling overcapacity. Additionally, starting in 2012, the slowdown in economic growth among major global economies weakened external demand, further dragging China into deflation. In 2014, Li Keqiang focused on the stock market to bolster market confidence and alleviate the pressure of economic deflation. He implemented a series of capital market reforms, including the Shanghai-Hong Kong Stock Connect, which encouraged institutional investors to engage in the stock market, coupled with the central bank's monetary easing measures. These policy directions indicated to everyone that a bull market was approaching, prompting people to dive into stock trading. However, at that time, the stock market lacked state support, and China's regulatory capabilities over capital markets were still quite underdeveloped. Additionally, Xi Jinping had not yet dealt with his political rivals, which meant that his attempts to drive up A-shares inadvertently provided an opportunity for financial factions to challenge Xi Jinping's authority. This led to one of the most severe stock market crashes in Chinese history and a significant outflow of capital, resulting in a loss of 1 trillion yuan in foreign exchange reserves within a year. Following the crash, Li Keqiang gradually lost control over economic policy. To stabilize the market, he was forced to abandon his stringent approach to regulating the real estate sector and the local debt, resulting instead to raise housing prices to reduce inventory. The ability to rely on real estate to boost the economy at that time was primarily due to low household debt levels, which allowed the residents to take on more leverage. However, this approach was only a temporary fix. Once households reached their debt limits, housing prices would rise to levels that young people could no longer afford, resulting in a decline in birth rates. As a result, the household sector would enter a prolonged period of deleveraging, a situation we are now witnessing. Now, how does Xi Jinping's current situation compare to the previous 2 rounds of economic stimulus? What advantages and disadvantages does he face? Let's begin with the disadvantages. The most significant issue is that China has fallen back into deflation, and the situation is even more severe than in 2015, creating a mix of internal and external challenges. Domestic demand is lacking, while external demand is being hampered by the US-led push for supply chain decoupling from China. In 2015, households still had the capacity to increase their leverage, but now only the central government has that option. If the central government is also unable to raise its leverage, there will be no effective solutions left. However, Xi Jinping holds a significant advantage compared to 2015. He now controls state-backed funds in the stock market. This makes it almost impossible for financial elites to ambush him in the capital markets and drain another $1 trillion in foreign reserves. A repeat of 2015 stock market crash is highly unlikely. That said, it doesn't mean there won't be a crash. The power to harvest has simply shifted from the financial elites to Xi. If he ever chooses to reap profits, he can do that at any time. The only difference is that the money won't flow overseas. Instead, it will be used to shore up the regime. It's a classic tale of the dragon slayer turning into the dragon. This is why Xi Jinping now has the confidence to replicate Li Keqiang's 2014 strategy of using the stock market to rescue the economy. He believes there's no longer any financial elite left capable of cutting into his state-backed resources. So we might see an interesting development. Perhaps a new financial challenger could unexpectedly emerge, causing Xi to fall in the same trap a second time. Now that we have assessed the situation, it's time to do the math. Economists are pushing for a 10 trillion yuan stimulus, but when compared to the 4 trillion injected in 2008, this 10 trillion doesn't carry the same weight in relation to GDP. And they are right. No need to look back as far as 2008. Just take the price hikes and inventory reductions of 2015 as a reference. Between 2015 and 2017, the central bank expanded its balance sheet by over 8 trillion yuan through relending, with a number of interest rate cuts and a reserve ratio reductions. The monetary easing during that period was much stronger than it is now. So if we are talking about a stimulus, this 10 trillion today may not pack the same punch as it did in 2008 or 2015. The real issue is how this money will be spent. If it's like 2008 or 2015, where the funds are just poured into investments to artificially boost GDP, then even 10 trillion or 20 trillion might not be enough. The returns on GDP growth diminish the more you spend this way, requiring more money for smaller gains. However, if the 10 trillion is directed towards improving people's lives, it would absolutely be enough. Take rural pensions, for instance. There are around 170 million farmers receiving pensions. Raising the minimum payout from monthly 100 yuan to 1,000 yuan would only require less than 2 trillion per year. Drawing from Japan's example, China's central bank currently holds over 40 trillion yuan in assets, which is only about 30% of the country's GDP. Meanwhile, Japan's central bank has expanded its balance sheet to over 90% of its GDP. This suggests that China still has room to expand by an additional 70 trillion yuan. If the central bank injects 10 trillion yuan annually, they could sustain this level of stimulus for another 7 years. Certainly, there are trade-offs to consider. After Japan's central bank significantly expanded its balance sheet, the yen lost value by 50%. If China's central bank were to expand its balance sheet by 70 trillion yuan, the exchange rate could potentially drop to $1 to 10 renminbi. However, it's important to acknowledge that the Communist Party, particularly under Xi Jinping, tends to resist welfare initiatives aimed at improving the lives of citizens. Even Wen Jiabao, who was seen as a proponent of market-oriented reforms, chose to maintain the share of established interests in 2008 instead of pursuing higher incomes for the public or transitioning to a demand-driven economy. Therefore, it's important not to set expectations too high, especially with the recent speculation about a 10 trillion yuan stimulus, which could further ignite the already volatile stock market. If the fiscal policy ultimately fails to deliver the promised 10 trillion yuan or to adequately support essential welfare programs, unmet expectations could lead to a drop in stock prices. As for the rescue strategy, Xi Jinping's approach this time is quite simple. He aims to treat the stock market like the real estate sector of the past. The idea is to get the entire population involved in stock trading, funneling funds into state-owned enterprises, which would then use the inexpensive capital raised from the stock market to drive up GDP. It can even be said that if the Chinese public's enthusiasm for stock trading surpasses government expectations, resulting in substantial savings flooding into the stock market and many individuals actively taking out loans to invest, the anticipated welfare policies could end up being neglected. Once retail investors are mobilized, there's no need for further incentives. Everyone will be confident in their ability to profit from the stock market, which would diminish the trend of lying flat among young people. When there is money to be made, who would still turn to the government to ask for welfare? As a result, I'm not very hopeful about the extent of fiscal policy implementation. I have significant doubts about the Communist Party's willingness to invest substantial funds in social welfare initiatives. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, stay well.